Welcome to the Wealthwise Show, where financial wisdom meets the road to prosperity. Get ready to embark on a journey to make wise financial decisions and unlock the secrets of building lasting wealth. I'm your host, the Wise Investor, and just as a disclaimer, go get some compliance out the way. This podcast is intended for educational purposes only. It is not intended to be tailored personal advice, because I don't give personal advice on the internet. So keep that in mind as you continue to listen to this podcast. That is for educational purposes only. And if you hear a product, like a service or a company, anything like that, I'm not endorsing them unless they're sponsoring the show. Well, then it's an endorsement. So just keep that in mind as you get into today's episode of the Wealthwise Show. All right, guys, welcome to another episode of the Wealthwise Show. I'm pretty sure it's in the intro. The intros are pre-recorded, by the way. But just to do some compliance, get that out of the way. This episode and this podcast, this show, is for educational purposes only, guys. It's not intended for a signal service. It's not intended for using for personal investment advice, because I don't give advice on the internet. If you're one of my clients, then hit me up in the email or text me. Don't be listening to my show for investment advice. Any companies, tickers, any products I may mention, they're not endorsed unless stated. And they're not sponsors unless stated. So I'm pretty sure that's the same thing, but I just want to clear that up. So with further ado, remember, educational purpose only, not intended for personal advice. Please seek the opinions of professional investment advisors, fiduciaries, and things like that. All right, so let's get into today's show. So today's show is pretty much all about something that I've personally know all too well, and something that I'm personally deal with on a daily basis, because as many of you know, I trade future commodities. I love it. It's just something about it that just, it intrigues me. And this is something as a trader that I deal with quite often, as well as, I know a lot of people who are investors, they deal with this as well. Like some of my clients even deal with this. I've talked to different prospects who dealt with this, and what is this I'm referring to? Well, that is having a overconfidence bias. So when you hear overconfidence, you clearly know what that is, and you know what bias is. Well, when you combine them, how can that affect you when you are making investment decisions, or even trading decisions, or any decisions when it comes to finance? It can be overconfident bias in a certain house, like, hey, I'm pretty confident that this house is going to be great, blah, blah, blah. Or I'm pretty confident that this new business venture I'm starting is going to be, I see how the economy is doing, but I know I'm going to be different, So what is overconfidence bias? Pretty much is when you refuse. Well, I wouldn't say refuse. It is when you are thinking way too highly of your skills and knowledge, where you feel like, it's, what's best, this is correct. All the other information, the opposite side, that has nothing to do with me. And why it's important to understand the difference from being overconfident and having conviction. That's something I'm going to explain later, because sometimes they get conflated. People feel like, oh, I have conviction in my process, but overconfidence, it comes with a sense of arrogance. And when you typically have that sense of arrogance, you have a very tough time of even seeing your convictions. Because, like, if I know a company, or let's say, for example, a commodity, if I feel like oil is going to go down and I'm pretty confident, like my conviction, because all the data says it's going to go down. But then that data starts to change and it says, hey, it starts pointing towards the opposite. And now my conviction is there. Like I'm pretty sure I'm correct on the direction, but my ego refuses to let me be wrong. So I might make temporary mistakes. Like, okay, if I know we're going down, but this might be a pullback or a pull up, a retracement, because the data says this, and it might be a retracement for a few days, few weeks, maybe in a few months. My conviction says something, but my overconfidence won't allow me to make adjustments in the time that will prevent me from losing more than I would need to if I was otherwise, not overconfident. So it's basically, like I said, it's when people are overestimating their skills and knowledge. And typically that can be you can tell that a person has overconfidence bias when they trade too frequently, which incurring high costs. They ignore relevant information and feedback because of this bias. Most people who are suffering from overconfidence bias, you typically make poor financial decisions. And so I want to explore the concept of overconfident bias and the impact it can have on your financial and investing journey, and how to potentially avoid falling prey to this trap, essentially. So understanding confidence, I keep saying confidence bias because there's nothing wrong with being confident. It is the overconfidence that's the issue. So understanding that, yes, we're all smart. I mean, if you're listening to this podcast, you're obviously learning something new. So you're constantly taking in information. You're constantly taking in knowledge. And so you see the need for development in your knowledge, abilities, and skills. But it's when you start to, I'm re-explaining overconfident bias again. Sorry, I'm looking at my notes and I don't know why I put the same thing twice. But anywho, most people do tend to believe that, they are, I would say above average smart intelligence. And by the way, too, I want to point out that a lot of this information that I got about overconfident bias, I did get from Investopedia. And like I said, they're not a sponsor. I'm not endorsing them. I'm just letting you know I'm citing my sources, essentially. But yes, a lot of people feel like they have an above average intelligence, which makes sense because humans are smart. Look at the accomplishments humans have made in the last 10 years. I would say last 20, but we got AI now, where 10 years ago, you'll never think that you can just type something to, a computer and it can write code for you. It can write anything. It can make pictures, art. So in the last 10 years, humanity pretty much had exponential growth. So clearly humans are smart. We all know that. It's when you feel like, it becomes a problem when that intelligence start to supersede your ability, that that perceived intelligence supersedes the ability that you actually have. And like I said, I did get a lot of this sources from Investopedia, and one of the things I see here is researchers have found that 73% of American drivers claim that they have better than average, to be better than average, which is statistic. If you guys stick with me long enough, you'll see that there are certain words I cannot say. And instead of cutting them out to act like I know how to say these words, I'm just going to do my best. And hopefully you understand. Statistically impossible. Because exactly half will be better than average. So, because of this natural human tendency, our judgment is highly susceptible to overconfident bias. And that is the that is the truth. But the issue is when, you know, the reason why, this is important to kind of understand, because when you're making financial decisions and when you're making investment decisions, and when I say financial decisions and investment decisions, they're technically the same, because they have to do with finances. But I'm talking about financial decisions in your life, like, buying a car, not listening to your spouse because you don't value their input when they say, hey, maybe this is not a good time to go and buy a boat. But you're so confident in your ability to make that money back from whatever you're doing. So that's what I'm trying to help you guys understand. When I say financial decisions and investment decisions, technically they're the same, but when I say investment, I'm more talking about equities. Stocks. Yes, pretty much. So one of the things, I know that was a little weird cut. I'm producing on the fly, guys. Be patient with me. So one of the things that I personally have to deal with when I am trading is directional bias. Having overconfidence in my directional bias. And what that means is, like, as an investor, majority of the time you're investing for the upside, meaning whatever you're investing in, you want it to go up because that's why you're investing. That's how you get profit. But as a trader, you can make money when it goes up. You can make money when it goes down, essentially. So when I say directional bias as a trader, I am saying that, if I feel like the market is going to go down and I'm shorting the commodity or the future contract that I'm trading at the time, and it does not do that, then one of the things that I tend to do is sit in pain. And I don't do it often. I only do it, I usually have a stop loss. So for everyone's like, what is he talking about? Sit in pain. I have a stop loss, guys. And the stop loss prevents me from losing more. My stop loss is, the hey, get you out of here guy. If you're not paying attention to what you're doing, it'll get you out of there. But sometimes if you know that, hey, I don't feel confident about this direction, but I am overconfident in my ability to make money in the markets, then even though I have the stop loss up, knowing, hey, I'm not gonna lose all my money, I'm okay with losing this amount of money, but instead of getting out because the new data came in and it should help you decide, change your opinion on the market's direction, I'm just gonna stay in it until it hits my stop loss. And that is unnecessary losses. That's unnecessary pain for no reason. And one of the things that a lot of traders and a lot of investors have, and even some professionals, is when they consider themselves to be above average in their ability to predict the direction of the market. And honestly, that is impossible for most analysts to be above average or even to predict the direction of the market accurately. So even thinking that you can, predict which way the market is going to go is a form of arrogancy, because you really don't know. Like, no one really knows. Like, you're talking about from algorithmic trading to like actual people pushing a button, putting money in there. There's so many different personalities and businesses and companies that is in the market. To know what all those people who are going to dictate the direction are going to do, can be nearly impossible. And so predicting the direction of the market accurately, I should say. When I mean by accurately, I'm talking about, the ups and downs. Like, virtually, if you can predict the direction of the market accurately, I'm talking about like to the cent, then you should be a quadrillionaire. You should never have any losses. But the issue with having this overconfidence bias and the real danger that, it leads people to take larger positions, otherwise that they wouldn't, I can attest to that. And it results in more losses more quickly than necessary. And that's the issue. Like, even if you make the money back, like, I'm pretty confident in my ability to trade. But it's like, okay, yes, I can make the money back. But should you have to? Because you can't let that ego go when you're thinking about, the direction of the markets or this company. Like, it's okay to sit out a move and figure out, reassess, essentially regroup before you deploy your capital again. And, that's the main takeaway I want to of this episode, is not to say that if you have overconfidence, you're going to lose your house. No, because there's tons of people who are overconfident in their ability to trade or invest, and they make money. But the key is unnecessary risks. I'm all about risk management. Basically, that's all I do is manage risks. I manage risks for myself. I manage risks for my clients, and that's the only thing I see now is this an unnecessary risk? I only want to take necessary risks when it comes down to my livelihood and to my client's livelihood. And if you're overconfident in a particular company or asset class or such, you may very well be correct. But in the meantime, are you taking on unnecessary risks? And then, back to the article here, it does say that, research has shown that overconfident investors tend to trade more frequently, resulting in higher transaction costs. So that's something I believe I talked about in one of these episodes. I'm going to let you guys in on a little secret. I'm going to let you bring in the back and show you how the chicken is made. I record a lot of these episodes in a day or two, maybe a week. I think I have probably like 30 episodes that has already been recorded, and I just scheduled them because I do run a business and I do have a family and I do have other obligations. And so I do a lot in the day. So I can't do this every week like I want to. So that's why this show is more like topical on like overconfidence bias. It's not like the latest news or anything like that because I'm busy. So if I say I said something in an episode or two ago, I'm not going to lie to you, I don't remember which episode that was or when I even said it. But and I'm also like a guinea pig because I totally forgot the point of me going over what I was just saying. Oh, high costs for trading. So even though you as an investor, may invest in a company, you still pay a commission cost. A lot of times, depending on if you're with certain brokers who have free commissions and blah, blah, blah. And those transaction costs, are also considered a risk. Is it worth paying this transaction cost when you're going to have to buy one, then you got to sell, then you got to reposition. So you got 3 times you're going to be transacting. And then if you're trading 4 times. And so that eats into your profits. People don't think about that. Between taxes, transaction costs, and, just everyday stuff, that eats into your profits a lot. And a lot of people don't calculate that. So if let's say, for example, I put on a trade on the ES and I made $100. And then I put on another trade on the ES and, I was pretty confident the first time because I made $100. Now I'm down $150. So technically I'm down $50 for the day. I had to pay commissions twice. So you're looking at the first trade and the second trade. And then now, because I know the direction I'm in, I get back in and now I make $200. So did I make actual $200 for a day? Like, I'm green $200, but did I really make $200? Like, if you think about between the commissions and even the drawdown that I've taken, I'm pretty almost break even. Not like exactly break even. There is some profit there, but what I'm trying to say is it's not $200. Is what I'm saying. So taking unnecessary risks and you know having higher transaction costs lowers your returns, and then because you see green and because you was correct, then that develops a nasty habit of what's the word I'm looking for? I think it's like negative reinforcement. There you go. That's actually what I was looking for. And then a lot of times overconfident people will underestimate the risks associated with investments. So let's say if I'm trading the ES, which is the S&P 500, the NASDAQ is like the S&P 500, but in the Indy 500, which I think is a race. I don't know. I'm not a race car. I don't know why I even said that analogy because I know nothing about racing. Point is, the NASDAQ moves 10 times faster than the S&P 500. So to me, that's even more riskier because you could have the potential to lose exponential amount of money very quickly. So if I'm thinking I'm good in the ES, or let me switch over to the NQ, I can do the same thing, and more negative reinforcement, a positive reinforcement for negative things. I don't know. Someone can correct me on that later. So those are pretty much some of the risks. Excessive trading, which can lead to higher transaction costs and potential lower investment returns. Under diversification. So if you're overconfident as an investor and you believe that tech is going to be it, like tech is tech, then you're going to be under diversified when those interest rates go higher. That's all I'm going to say. And then underestimating risk, that can be super dangerous because now you are taking unnecessary risks. And then ignoring contradictory evidence. Like I said, an analyst comes out and says, hey, maybe investors should look into this. And you don't, because you feel like you know what's up and you miss out a piece of information that could have saved you a lot of money. And so that's, I'm at the 20-minute mark. That's pretty much it. So let's hide in my room. And I don't know what I said at that. Anywho, I got some more notes here, but they can be. Oh, here we go. Before we go, guys, how to avoid overconfident bias. I think I mentioned that in the beginning. So seek diverse opinions, and this is directly from Investopedia. Seek diverse opinions, consult with others, and consider diverse perspectives, whatever that word is, before making financial decisions to avoid relying solely on your own judgment. Especially seek out contradictory evidence or opinions. So basically what they're saying is, listen, like it's okay to take in knowledge, even if you think you know it. Take in knowledge from the same subject but from a different author. That way you can see their perspective on it. Continuously educate yourself. So like I said, staying informed, and like I said, being humble and seeking out more knowledge. Keep an investment journal. That is something that I personally do for trading, but I am going to start doing for my investing. So basically what that is maintain a record of your investment decisions and the reasons behind them and the outcome. And the reason why this is important, especially when I'm trading, is if let's say I woke up on the wrong side of the bed. I have my neck was cramping because I slept on my neck wrong, and I'm irritated because of that. And I just woke up, things are not going right. My computer taking a little too long to turn on. I got like 30 emails, and I start trading for that day. And I don't notice at the time that is going to affect my trading outcome. So if I write down exactly hey, this is what happened that day, and this is the outcome of that trade. When I go back and read the outcome of that trade, I say, oh, well, that I did have this, and I start noticing a pattern, and that helps you identify patterns in the future. So let's say a month or two later, same thing. I wake up with a cramp in my neck, and things are just not going right for that morning, and I say, hey, this reminds me of the last time that I tried to trade and I didn't have a favorable outcome. I'm going to take my time with this one. I'm going to actually assess the market. And if I don't see something right away because I'm not feeling good, I'm just going to close the computer. And that's what keeping a journal is going to do, is help you learn from your past mistakes to basically, evolve into a newer a trader / investor. And then, also setting realistic expectations. That is something that a lot of us do not do, especially myself, is knowing our limits. The biggest thing about overconfidence is thinking more of your skills and your limits than realistically it is. So set realistic expectations and practice self-awareness. We all actually have self-awareness, but we ignore it. I know I do. So I know I might not be doing something correctly. I think it's called the conscience. We have this thing where it tells us, hey, this is wrong, but you can decide to listen to it or not. So practice self-awareness, regularly assess your confidence levels, and then question. And that's what I've said this 100 times. Question your beliefs and assumptions and biases to keep them in check. Always ask questions, because if you blindly listen to someone without questioning them, then are you really, I would say, know what you're doing? That's the nicest way I can say that. Emphasize risk management, which we talked about. Don't take unnecessary risks. Systematic decision making. That's really more so for, I would say, for traders. And then recognize. I'm not gonna say that because that's just dumb. So that's pretty much it, guys. Hopefully you guys learned a lot. If not, I'm terribly sorry. Like I said, I record 30 episodes in a week, so I can schedule them all out. So some of them I might be high energy because that's the beginning of the week. Some of them might be low energy because that's the end of the week. I'm still working on this. But you're going to get what you're going to get. And hopefully the information is suitable for whoever you're listening. So I appreciate it, guys. I think that's it. Yeah. So, this is episode 21, I believe. It's 21 episodes. And when I say I had 30 episodes, I mean there's episodes that are scheduled months in advance after this episode. So eventually I'm going to get it to where, and that's also why I'm not doing the video too, because I do so many, and editing that much video would be a nightmare by myself. So eventually I am going to work on getting a podcast studio, and some people in my area have some of those, and eventually get in and try to kind of build this thing up, see where it goes. So I appreciate you guys listening. Hopefully you guys took something from this podcast that you can use in your daily lives, not just in finance, but hopefully in this journey called life. And until next time, guys, I appreciate you, and stay wealthwise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the Wealthwise Show. The Wealthwise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.